specialist from one of the financial advisory firm in Singapore. I specialize in REIT investment and also the legacy planning. At the same time, I am also the SGX trainer, training the investor and also the professional regarding the Singapore REIT investment. Every month, I am on Money FM 89.3, sharing about the monthly market outlook for Singapore REIT. So if you're interested, you can go to Google and search for my money update since 2020. I run a website, the REIT screener website, REIT Savvy. Later, I will show you some of the features and what are the tools that you can use at REIT Savvy to do your REIT analysis research. So today, webinar will be focusing on the REIT itself. I'll be sharing a few examples and also some of the REIT name will be mentioned in this presentation. But do take note that whatever information I share here are just for education purpose. They are not a buy or sell recommendation. So I would strongly advise you to do your own due diligence first before you are starting your investment journey. Okay, today's agenda, there will be 4 typical agenda. I will share about the interest rate direction and what would be the impact of interest rate on Singapore REITs and where are the risks and opportunity, all right, during the current market condition. And lastly, I will have an interview session with a S-REIT REIT incoming CEO to share about S-REIT REIT as a whole. Okay, let's look at the Singapore 1-year T-bill. Okay, at the present moment, since 2023, Singapore T-bill has been plunging, is currently on a downtrend. And it's unexpected the T-bill will continue to go to the low level because the inflation has been eased. So at the present moment, it's 1.35%. If you're still holding a lot of T-bill or holding a lot of fixed deposit, you may start to plan what will be the next step because moving forward is expected the rate will be continuing to come further down. 10-year risk-free rate is also coming down drastically after breaking the support of the multiple top. If you understand the technical analysis, the Singapore 10-year risk-free rate has been forming a multiple top and recently just started to broken down. So the current trend is down, and all the downtrend of the risk-free rate and also the interest rate will be also helping the S-REIT moving forward to be bullish as a whole. And Singapore overnight rate is also coming down at 1.22%. Okay, you can see that if the interest rate continue to come down, I would not be surprised that it can go back to the 2020 to 2022 level, which is quite close to the 0%. Okay, and Singapore saving bond also, the interest rate is also coming down. The 10-year average interest rate at the present moment is around 1.83%. But if you look at the first 3 years, the rate would be 1.39%, 1.48%, is 1.54%. All right, so it has been coming down from 3 point something percent to below 1.5% at the present moment. And Singapore bond yield curve is also normalizing, and we will not going to see the high interest rate for the short duration fixed deposit because you can see from this curve itself, 12 months ago, the Singapore short-term interest rate, they are still above 2.5%. And this is the latest curve, latest yield curve. The shorter end has already dropped below the 1.5%, but the longer end is still above a 2%. And moving forward, I am also expecting the shorter term interest rate will be continue to come down and the whole yield curve will be normalized eventually. So what should the investor do? All right, that is a bottom line. That is a basic question. The SORA is coming down, T-bill is coming down, Singapore saving bond is coming down, fixed deposit is coming down. So basically, whatever cash you are holding now, is expected to receive a lower interest rate. And if do nothing, basically the consequences that your purchasing power will be eroded by inflation. Then the investor need to start asking themselves, if you want to do something, you want to optimize the return of your cash or optimize the purchasing power or maintain your purchasing power. Basically, you need to identify where are the opportunities. whether is it in a bond or in the equity or in the REITs, you need to identify where are the opportunity. And when you have identified the opportunity, you have to ask yourself, if you are investing in the current market condition, what are the risks? And the next thing here is how to manage a risk and how to do it. All right. So today my focus will be more on the Singapore REIT itself. Okay. Of course, there are some other asset class you can take a look into. Now, move forward, that we'll go to take a look in the 2025 US interest rate outlook, because this interest rate from US direction, you have a big impact on the S-REIT moving forward.
Tomorrow.
Right. Someone has to mute your speaker. Sorry. Okay, so this is based on the FOMC dot plot, the most recent dot plot. At the present moment, the US interest rate direction is expected to reach around 3.75% or close to 3.5% by end of 2025. Okay, so this is based on the dot plot projection. And by end of 2026, the US interest rate is expected to reach around 2.5%. So all in all, in short, the interest rate is coming down, okay? And based on this projection. And based on the 30 days Fed Fund future rate, okay, this is tradable in the futures market. By end of the year, right? By end of the year, December 2025, there is a 98.4% probability there'll be 50% rate cut, okay, from the current level. Current level is 4.25. So the next Fed Fund rate cut is expected on October 29. And by end of December, the interest rate for US interest rate will be coming down to 3.75. And by end of 2026, there will be 86% probability of at least 100 basis point cut. Okay, so in short, the general direction for the interest rate is coming down, is for sure coming down. So translate to the personal finance or whatever cash you're holding in a bank, it is expected the interest rate for all your cash holding will be coming down also. So there are four ways of interest rate impact the Singapore rate. Okay, first of all, the reduction of the interest rate will help the REIT to have the reduction in interest expense. That will have benefit with the REIT with a high financing cost. Okay, and also the short debt maturity profile. Okay, in short, the DPO, the distribution per unit, or the dividend payout by the REITs will improve moving forward. And secondly, the property valuation is expected to improve or grow again because the interest rate has an inverse relationship with the property valuation. Okay, this is very obvious when we compare those REIT with the overseas portfolio, okay, besides Singapore, right? And it's expected there will be the re-rating of valuation, and that will also help to boost in the net asset value of the REIT. Okay, so in general, okay, I'm talking about in general, right? You'll be REIT specific in this observation. When there is a cut of interest rate, not all the REIT you have an immediate impact because it's very much depends on what is the current interest rate they are paying now and what would be the debt maturity profile. The REIT have a shorter debt maturity profile and lower hedge ratio will benefit the rate cut immediately. If they are able to benefit from the cut in interest expense, it is expected their interest coverage ratio will increase. A little bit technical here, but in short, rate cut will help the REIT to increase the DPO. Okay, that is a short answer. Okay, at the same time, because of the growth in the net asset value, the gearing ratio is expected to come down, and that will also help in the upside potential, all right? Because a better gearing ratio or lower gearing ratio reduce the risk of the REITs itself. Okay, and do take note that although the interest rate is coming down fast, but not all the REITs will enjoy the rate cut immediately because it's very much depends on how long the debt maturity profile that they are currently having now. The longer the debt maturity profile, they may not be able to enjoy the immediate rate cut, and also very much depends on what is the percentage of a fixed rate they hedge at current moment. Okay, so you have investor have to take into a detailed look in the debt maturity profile and also the fixed rate interest rate percentage. Okay, when you analyze the individual rate itself. Okay, the third way interest rate will impact the Singapore rate is the institutional fund flow. At the present moment, the institutional fund flow, they are still not fully deployed into the Singapore market yet. Okay, this is the good news, because at the present moment, the US 10-year risk-free rate is still pretty high. It's still staying above 4%. Recently just come down just slightly below 3.96%. But in short, they are still at a high level. For the past 2 or 3 years, the S-rate has an inverse relationship with the 10-year risk-free rate. Okay, if you look at the US 10-year risk-free rate, when the 10-year risk-free rate is at the high level, okay, the rate will be at the trading at the bottom. When the risk-free rate coming down and the rate index will go up. Okay, so you can see the inverse correlation over here. So at the present moment, the 10-year risk-free rate is still quite high. So the S rate is expected to be muted unless it break the current 4% level. Okay. Lastly, this is really impacted the investor in Singapore very much. Okay, especially the yield-seeking investor. Singapore T-bill, fixed deposit, Singapore saving bond are plunging below the 2% now. Okay, so there are a lot of retail investors are looking place to park their money for higher yield, and that's the reason there would be the potential flow from a T-bill. There are a lot of money in the money market fund and also the T-bill and also the fixed D. They may want to deploy into the U asset class, okay, such as the dividend stocks, the risk, private credit, and the rest of the fixed income. And this is a comparison table. I just put all the yield asset class together so that to give everyone some colors, okay, some indication what will be the yield comparison. Okay, so I'll go through this table slowly. Singapore 6-month T-bill at the present moment giving us about 1.4%. 1-year T-bill 1.35%. SSB for the first year 1.39% compared to our CPF OA 2.5%, CPF SA 4%. Then the fixed deposit offered by Maybank at the present moment is 1.1%, OCBC 1.15%. You can see that actually all the short-term rate is pretty low. If the investor know how to analyze other asset class, at the present moment, the low-cost global bond fund is giving us about 3.48%. The short duration bond 4%. If you are able to take on slightly higher risk, the high yield bond in Asia give us around 7 to 8%. All right, but do take note, all these asset class they are not risk-free. Okay, but the 6-month T-bills, Singapore saving bond, OASA, they are considered risk-free. So when you want to look for higher return, higher yield, you need to take some risk in the market, and you have to understand the risk, and you must know how to diversify your risk away. And the REIT ETF and also Singapore REIT as a whole at the present moment giving us about 5.5%. This is the average. Some of the REIT definitely is offering higher yield at the present moment. Okay, and there's another space which is not traded in the secondary market. They are all in the private market, in the private credit here. So the private credit is giving us the yield between 7 to 10%, right? But all these are alternative investment. They are for accredited investor only. If you're eligible as an accredited investor, you can take a look into this private credit space. Okay, so in summary, these are the 4 ways of interest rate can impact the Singapore REIT. Okay, in short, I summarize again. A cut in interest rate will help to boost the DPU, and it's expected the property valuation will improve and there will be a re-rating of valuation. If the 10-year risk-free rate from US is coming down, I am expecting the institutional investor will come back to Singapore sector again. That will boost the REIT sector in Singapore as a whole. And lastly, the yield-seeking investor, they have a big chunk of the cash sitting on a sideline. They may come into this yield asset class space to look for the asset class with a higher return. Okay. Now I move on to Singapore REIT fourth quarter 2025 and where are the risks and opportunity. Okay, first thing first, I will give everyone an overview what is the current price to book the FTSE ST REIT index is trading now. So you can look at this FTSE REIT index chart itself, all right? Before the COVID, the S-REIT index was trading at the price to book of 1.1 times. And during the COVID crash, it's dropped to 0.8 times. And after that, there's a strong rebound back to the price to book 1.1 times. Now, at the present moment, the whole S-REIT sector in Singapore as of October is trading at a price to book of 0.85 times. Okay, so if you compare to the 5-year high and also a 5-year low, the S-REIT index is trading close to the 5-year low. 5-year low is 0.8 times. Now, at the present moment, is 0.85 times. So, what does it mean? This means that if everything back to normal, there would be 25% upside potential for the REIT index to go back to the price to book 1.1 time with the annual dividend yield of 5.5%. Okay, so in short, the S-REIT sector currently is underpriced. Okay, underpriced, and 5.5% is a pretty attractive dividend yield as a whole. Okay, recently there was a rally for the past few months for S-REIT index. Many investors start asking, is it still the right time to go in, because it has been rally quite strongly since beginning of the year. Okay, if you look at this chart itself, okay, it's clearly showing that the REIT index is reversing a trend. Okay, this one is trending down. Then after that, they find a bottom moving sideways for a while, and recently the trend has just started. But one word of caution would be, do pay attention to the current level, because the S-REIT index is facing a resistance ahead. Okay, there is a very strong resistance here. The S-REIT index has to break. Okay, this will be very much depends on whether end of this month, the US FOMC, whether they will cut the have a rate cut. That's one criteria we need to pay attention to. And the second thing is will be very much depends on this quarter earnings result. If this quarter earnings result, most of the REIT are positive or show growth in dividend due to the interest rate cut, and the US is also cutting interest rate, I am expecting this resistance level to be broken, right? If this resistance level is broken, I am expecting the FTSE ST REIT index will continue the bull trend into 2026 or 2027. Okay, so this we need to watch this closely. Okay, vice versa, if the US Federal Reserve did not cut the interest rate this month, and the earnings release is not as good as expected, and I will not be surprised the current level you start to have a correction and start to come down, waiting for the next good news to happen. So current opportunity by grouping, typically there are 4 opportunity, okay, that I have identified. If you really want to focus on a dividend play, okay, there are certain group of a REIT, they'll give you a very stable dividend between 4 to 6%. And these are the big cap backed by the strong sponsor, Mapletree, CapitaLand, Fraser, and Keppel. Okay, the other group will be the alpha play. All right, this is where the good opportunity are. This category dominated by the small and mid-cap REIT. Okay, at the same time, they will be also benefited by the 5 billion Singapore Equity Market Development Program. Okay, because we have seen that small and mid-cap stocks has already rallied quite strongly recently, and this is expected to to continue to have a bullish sentiment moving forward in this sector. Those REIT have a good fundamental, but the stock price has been beaten down because of the drop in valuation, especially those REIT with overseas property. And this REIT also underpriced based on book value, and they also offer the very high yield of 7 to 8%. Okay, Cecil REIT basically belongs in this category, alpha play. The third category would be the turnaround play. I am referring to the U.S. commercial office because the U.S. commercial office has been beaten down badly due to the low occupancy in U.S. and also high interest rate environment in U.S. So this group of REIT currently offering the very deep discount, and at the same time the dividend has been suspended. Okay, these are the high risk and also turnaround play. And then lastly would be the speculative play. Those REIT which has a very low trading liquidity, they may face potential privatization and also delisting, right? They are also underpriced and also illiquid. These are the small cap REIT, okay? But these are purely a speculative play. So investor, you need to base on your risk profile to identify which group are the REITs you are interested in or suitable to your own investment objective. All right, I give you a snapshot of where are the decent DPU for the big cap REIT at the present moment. The largest REIT in Singapore is CICD, CapitaLand Integrated Commercial Trust. Market cap close to 18 billion. TTM yield 4.7%, followed by CapitaLand Ascendas REIT 5.3%, so on and so forth. The small and mid cap offers the most attractive DPU yield. Stoneweg European Staple Trust giving us around 9%. Cecil REIT based on yesterday's price giving us a 8.9% a dividend yield, followed by Elite UK REIT. Okay. And there are also a number of REITs are trading close to the 5-year low in terms of price to book. Okay, you can see here Digital Core so-called are the cheapest, the most underpriced, followed by Lipo Mall, CDL Hospitality Trust. Okay. And the REIT which has the lowest gearing ratio is the Cecil REIT, followed by Ames APAC REIT and also Keppel DC. Cecil REIT at the present moment is giving us that has a gearing ratio of 25.8%. All right. So they are quite interesting financial ratio offered by Cecil REIT. Cecil REIT is one of the highest, has one of the highest DPU and also one of the lowest gearing ratio. So without further ado, I want to invite the incoming CEO of Cecil REIT, Xin Yuan, to share about how Cecil REIT able to deliver this kind of financial ratio. All right. So these are the typical question I will ask Xin Yuan. All right. I will ask Xin Yuan to introduce the Cecil REIT and what would be the outlet mall model, because this outlet mall model are not the mall model in Singapore. What's so special about this outlet mall model? And I also ask Xin Yuan to share about the portfolio and performance and go through some of the financial ratio and also the goal and strategy. And lastly, everyone can ask them what would be the risks and challenges. Hi, Xin Yuan. Welcome
Hello.
to this live streaming. All right.
So thank you,
yeah,
Candy, for inviting me to this webinar.
Yeah. So, Xin Yuan, maybe for a start, would you like to do some basic introduction? What is Cecil REIT and what makes this Cecil REIT among the unique among the Singapore REIT?
Sure. I'll be able to give our audience some insight. But first and foremost, I'd like to welcome everybody and spending an afternoon with us. So, but before I go into the first question, I would like to say that the sharing by Kenny provides a very good insight. So one of it is that he says that most of the interest rate, the fixed interest rate, the bond yields are all down, and most of them are below 2%. So when I look at these percentages and I look at our dividend yield, which is on the 5-year average of 8.5%, this actually to me, if I'm a personal investor, private investors, this would actually present me a very good yield in terms of my investment. So without more on that, I will go on to elaborate on what is Cecil REIT. So what is Cecil REIT? So first and foremost, S-REIT is a real estate investment trust listed on the main board of Singapore Exchange since 2018. It is the first outlet REITs listed in Asia. All the outlets are actually located in China with an initial portfolio, and the total AUM is around RMB 8.4 billion. As a small to mid-cap REIT, we have a market cap of about 850 million Sing dollar and offer an attractive dividend yield of approximately 8.9%. Next page. So this page shows, I will spend a bit of time to elaborate to you on our sponsor, which represents one of the key strengths of our SREIT growth and offering a differentiated value proposition. It was founded by our chairman, the guy in the picture on the right. His name is called Victor Xu. He's a leading outlet operator in China. Rooted in Chongqing, he possesses deep insight into China's evolving retail landscape. He pioneered the innovative super outlet. So what is super outlet? It is known for integrating art into commercial space. So today, the sponsor currently operates 19 outlets across China, Dong, Nan, Si, Bei, North, South, East, West. 4 are held under SREIT, 2 are directly owned, and 13 are operated under asset-light model. So SREIT's outlet strategy focuses on discounted branded fashion and sportswear, mainly appealing to China value-conscious consumers. We adopt a hands-on, commission-based management model, which aligns our interests with the sales performance of our tenants. Next page. Okay, this page shows what is our unique super outlet. So you will see the formula A times 1 plus N times DT and S times S. What is A? A means art. You will see that most of our building is actually brick wall Italian style, mimic Italian castle. So it's an artistic and distinctive outlet design, which is meant to strengthen our brand identity. So what is N? Stands for enhancing the retail experience. For example, you will be able to find super sports and super kids zone along with unique attraction. We have indoor zoo available in Hefei and a strawberry farm in Chongqing outlet. And of course, we also utilizes data technology, which use big data to optimize our tenants mix and operational efficiency. Last but not least is our sustainability. Demonstrate our commitment to eco-friendly growth and meaningful community engagement. Next slide. Okay, this one I will spend a little bit of time to explain to you, and you will be able to appreciate the beauty of this EMA model and a key differentiator. So what is it like? First and foremost, on the left-hand side, you will see the bar outlet sales, of which most of our leases are not based on fixed rent, but is based on a percentage of sales, average between 10 to 16%. This becomes our gross revenue at the outlet model. But at the REITs model, we have this EMA resultant rent, which is made up of a fixed component and a variable component. What is this fixed component? It is set at IPO at a minimum amount and increasing at 3% annually, which actually provides our investor a downside protection. Regardless of the sales, this will be fixed and increasing at 3% every year. But of course, what happens if the sales go up? There is a variable component which is directly linked to our outlet sales performance, enabling our unit holders to benefit from potential upside in good years. So this structure offers what? It offers income stability and growth potential, aligning a long-term value for all our stakeholders. Okay. Next. Okay, this slide actually shows our stable portfolio occupancy. So as an investor in REITs, I think one of the key metrics that you will see would be our occupancy. So looking at the chart on the left-hand side, you will see that most of our occupancy is above 95%, hitting a high of close to 99% in 1Q 2025. So how do we do that? So we do that basically by partnering with tenants and strong brands. Our business aligns the S-REIT success with that of its tenant. Unlike many of the conventional malls where we actually work together with the tenants at a fixed rent. But for us, we actually collect a percentage of sales. Therefore, if the tenant win, we win. But if the tenant die, we will die. So that's why it has a vested interest between us and the tenant. And more than 90% of our leases are signed on this model. So this will provide us, the key tenants have a strong pulling power and are financially robust, reducing the risk of tenants' failure. So next reason is that we have a well-curated AEI. During an AEI, Asset Enhancement Initiative, session doesn't just refresh the paint, it actively reconfigures the space to attract trendy, highly demand brands, particularly in fast-growing categories. So all this cumulated together gives us a high occupancy. For example, Chongqing Liangzhang at 100%, and the rest are close to 100%, with Kunming outlet hitting 99.9%. Next slide. Okay, this slide actually, I want to elaborate further on the beauty of our EMA model. So what is the beauty of our EMA model? The green bar shows our sales. So just now we have already explained that EMA income is a fixed component and variable component. And the red line actually shows our EMA rental income. I think most of you would remember that back in 2020, when the COVID-19 first started in China, there was a massive lockdown, 7 weeks, I can remember clearly. That time, our 4 outlet was closed, totally shut for 7 weeks with no sales and no shoppers traffic. But you see that for the entire year, even though the sales has dropped in 2020 because it was closed for 7 weeks, but our EMA rental income provides a basic guarantee like an insurance. We have this fixed component. Even without sales, our sponsor will continue to support the fixed component rental. So for an investor like yours, you will be assured of a basic income. So this is the beauty of the EMA model. Okay, next slide. Okay, so then moving forward, I would also like to, whether this is sustainable and whether the consumption, the domestic consumption in China is actually booming. So maybe I just want to share with you some highlights in our recent anniversary sales. For example, which is held every September, this is our first day sales. For example, Chongqing Liangjiang, we hit a strong 234 million of sales in 1 day, which is a 30% year-on-year growth. So the rest of the numbers are, for example, Liangjiang 23%. And Kunming outlet, we did a major reconfiguration back in 2024, bringing in a lot of new brands, and that gave us, and we are seeing the results now, which is more than 72% growth. Okay. Okay, next slide. Okay, this slide basically shows our attractive total return and distribution yield. So our session rate since listing until now is about 41.2%, versus the FTSE is about 19.7%. So over on the right-hand side, you will see the DPU that has been distributed over the years from 2018 until now. You will see that it is actually quite stable and robust. So, Kenny, you have any further questions?
Yeah, I saw some question. Maybe want to elaborate further. Okay, so one of the question posted would be, how has the accessory managed to consistently maintain the high occupancy rate? I think it just now you mentioned a little bit. Maybe you want to further elaborate for those tenant who are not able to perform. What are you going to do with them, and how going to find the new tenant coming in to really maintain a high occupancy?
Okay, sure. So, first and foremost, thanks for the question. So what we do is that you will see that our WALE is actually quite short compared to the other REITs. The other REITs are basically around hovers between 3 to 5 years, but ours is about only 1.5 years. What's the reason for this? This gives us the agility to refresh our tenants mix. That means allowing us to replace underperforming tenants with those that align to evolving consumer trends and strong sales potential. So crucially, we have a highly experienced operational team on the ground who work closely with our brand partners. Their long-standing partnership with tenants allow us to continuously optimize the retail offering and keep our outlet malls fresh, dynamic, and relevant. So the next thing is I have mentioned earlier, we also invest actively in asset enhancement. So beyond operations, and the third factor that keeps our occupancy high, of course, is our EMA model. So over the past few years, we progressively add our strong capital refinancing strategy. For example, we progressively refinance our borrowings in RMB denominated loans, benefiting from China lower interest rate. So this is how we continue to keep the occupancy high and the DPU resilient.
Okay. Actually, I just want to understand what is the typical lease that you lease to your tenant in general?
Okay, our typical lease actually, the year is between 1 to 3 years, except for those, for example, I mentioned before, like the cinemas, the indoor zoos, which occupy a bigger space. Those we will sign on a longer lease, like between 5 to 10 years. But the bulk of our leases between 1 to 3 years. So the reason why we are doing that is because, as I mentioned earlier, we are actually on the win-win or die-die relationship with our tenant. So those that are not performing with shorter leases, we will be able to replace them with the performing one, which is in our pipeline.
That is a very smart way. It's by
Yes,
design. You purposely want to keep the list short.
correct,
All right.
correct.
Thank you. Thank you. All right. So the next question would be, what would be your growth strategy moving forward? And what do you think about a major growth driver for Cecil rate over the next 2 or 3 years? Because everyone of us knows at the present moment China current economy. So what is your view on that?
Okay, so our view on this is what is our current growth, our major growth drivers for accessory over the next 2 to 3 years. So our immediate focus is, of course, to maximize performance through targeted asset management and enhance our strong consumer engagement. Then, of course, one of it is our VIP members. So in our previous slides or our previous announcement, we did highlight a lot on our VIPs. We will cultivate a strong relationship with them. The reason being is that they contribute more than 60% to our monthly sales. That's why this will be continued. So then on the other aspect of growth would be Accessory has undertaken several AEIs to enhance value. Maybe I quote you one example. So in the past 2 years, what we did, just now you saw that the anniversary sales, first day sales for Kunming was year on year more than 70%. The reason is this, we did two major AEI. The first one is that we increased the parking lot by 400 lots because during peak hours, there's not enough lot. And the second one is that we shifted and reclustered 100 over brands. We spent about close to about $3 million to do the major reconfiguration so that the cluster will be the sports brand on one level, the luxury brand on one level, and all these are shown in our results in terms of our sales. So this will be our major growth drivers.
Do you have
Okay.
any plan to go for acquisition in China? That's the first question.
Mm.
And the other question, is there any plan to expand the mandate? Because this outlet mall concept seems interesting. Do you have plan to expand the mandate to acquire overseas property? So one is
Oh,
domestic, the other one is overseas.
okay, so I will answer your question in two parts. The first and foremost is that we will continue to comb through the asset that is in China now. So, for example, just now I mentioned to you, our sponsor manage about 13 asset-like models. So, what happened is that these 13 third-party outlet mall, many of these outlets are owned by smaller developers who have been severely impacted by the prolonged property downturn in China and are now open to divesting their asset at a significant discount. So these are what we are actually looking at now. That said, given the urgency and complexity of the situation, particularly where some developers are at the risk of bankruptcy, the sponsor may need to acquire this asset first before selling them to us. The REITs will therefore require time and careful preparation to coordinate such acquisition. So this is what we are looking at. And the other one is also there is a fundamental change in China towards the Southeast Asia country. So Session REIT itself is unlikely to pursue overseas expansion in the near term. But our Sasha group has been exploring opportunities to extend its operations beyond China with a particular focus on Southeast Asia. Why Southeast Asia? All of you would have heard about the tariff war, 100% tariff, which will be effective in November on China for exports to United States. So what has happened is that China's largest export now is Southeast Asia. It has overtaken US. And the other export market which has grown in the Chinese capacity are Latin America and Africa. So a lot of domestic brands, for example, like Li Ning and Anta, are rapidly broadening their retail presence across Southeast Asia. So this provides potential partnership opportunities for Sasha to leverage on this existing brand, which they already have a very close relationship back in China. So the Chinese domestic market continue to face product oversupply. You know that China is a manufacturing powerhouse. So they manufacture a lot of goods. So there must be an outlet for this oversupply of goods. And where are they looking at now? Southeast Asia. So we are looking at how our sponsor is moving into this part of the world. And if there's any future development, we will keep the market updated.
So Xing Yuan, I mean, in short, that sponsor may acquire or maybe set up this outlet more in Southeast Asia first and make it stabilize in terms of all those operations before Cecil Reed you take a look into it, correct?
Yes, we are looking into this joint partnership.
Or joint partnership, that means that maybe Cecil Reed and also the sponsor itself you acquire
Yes,
together and develop. Oh, that's interesting. Do you have any timeline?
okay.
You get me
No
excited.
timeline because this is actually a very initial one. So I do not want to deliver empty promises to the market, but just giving you some peek into what we are actually looking at because of the changing fundamental between the Chinese economy and this part of the world.
Yeah. So
Okay.
another challenges for the investor currently facing now would be the renminbi and also the Sing dollar exchange rate. Because as we know, you are collecting rental in renminbi but paying out dividend in SGD. How do
Mm.
you hedge the currency and make sure the dividend the investor receive they are not eroded due to the rate change?
Okay, so what we do is that as a Singapore listed REITs that earns income in Chinese renminbi, weakening renminbi actually is against the Singapore dollar, and that could also actually potentially reduce our distributable income due to the exchange rate weakening of the RMB. So what we are actually doing is that we actively employ a disciplined hedging policy. So for example, dividend date is March 2026. So 3 to 6 months in advance, we will be closely monitoring the movement of the exchange rate and hedge our interest rate for a more favorable rate for the next 12 to 24 months. So this will provide us a strong buffer against short to mid-term currency volatility. And of course, our RMB loan is a natural hedging. As you know that more than 90% of our loan are actually in RMB, which actually offers us a lower interest rate. All in all together, this will keep our costs low, and this will actually be an enhancement to our distributable income.
Thank you, Xing Yuan. Okay, I think time is running out. Okay, I will pose you the last two question. What is your vision for the Cecil Reed over the next 5 years? Because I also understand that you are newly taken this role, and I think your official date will be sometime end of this month, right? So to become a new CEO of Cecil Reed, all right? So what is your vision for the Cecil Reed
Okay.
for the next 5 years?
So, sure. Thank you for this question. So, before I share my vision for Accessory for the next 3 to 5 years, I would like to share a quote that our chairman Vitoshi wants me to share with our potential unit holders and our unit holders. So, you know that our operations actually run very well with only one statement. Their operations to the retail operators that you must treat the core focus is your shoppers. So whatever you do, you must think of the benefits and what are the value add you can bring to your shoppers. But if you turn it to S-REIT at this from this perspective as a capital market platform, your core focus is that you must benefit, whatever you do, the core focus should be to benefit our unit holders. So with this in mind, what is our 5-year vision? Is to transform S-REIT into the undisputed leader and pure play proxy for not only Chinese outlet, but beyond the shores of China, which we have just shared just now. We will build on this leadership through dual engine strategy. That means optimizing our core assets for organic growth and capitalizing on a strategic acquisition of scale. The result will be a REIT that commands not just a premium and deep liquidity, but unwavering confidence of the market.
Okay,
Okay.
last question. Xingyuan, is there any special message you want to share with our Singapore retail investor community?
Yes, I have. So I think the Singapore investor community face a very challenging time. Why? The sheer volume of stocks on the SGX, then compounded by the constant barrage of online information. There's so much information on the internet, makes it very difficult for investors to identify genuine opportunities. Kenny Low has actually provided very good insight. But the critical challenge is what I think is to develop a disciplined strategy to filter out the market noise and find the true gem. So personally, I will look at 3 indicators. Number 1, strong fundamental of the company. That means company with robust cash flow and a sustainable business. Next, it must have a track record of stable yield despite volatilities in the market. So, and lastly, intrinsic value in the stocks. The share price must be discounted from its true value. So personally, I will look at 3 to invest in any shares or stock. So for me, S-REIT delivers a stable high yield return through its resilient outlet mall business and strategically expanding to capture future growth in and out of China. So we have a low gearing, high yield, and growth potential. So this is my message for the Singapore investors community.
Okay, thank you, Xingyuan, for sharing
Thank
the
you.
insight for S-REIT. Okay, for the rest of the investor, okay, due to the time constraint, we are not able to share everything that it show in the presentation material. So for the investor, if you want to know more about S-REIT and also you need to have want to have a piece of presentation, you can come to the S-REIT website, okay, sreit.com, and you look at the investor relation and come to publication. There are many or presentation material. You can see that all the S-REIT previous financial result and also the corporate webinar business update all over here. You can find all of the information over here. This is from a S-REIT website. Okay, so if you want to know more about S-REIT, because I personally with a group of financial advisor, we visited S-REIT sometime in April this year to Chongqing. All right, so I have a post on this S-REIT outlet mall visit here. Okay, there are plenty of photo here and also some of the S-REIT financial ratio. Okay, and some write out. And you can see that just now Xingyuan mentioned about there's an art element in the outlet mall itself. You can see that this one, it looks like the some of the building in Italy. All right, I visited this mall in Chongqing, okay, at a Bishan, all right, Bishan, and you can see there are a lot of photo over here. Of course, I also blow my wallet shopping in the outlet mall. So you can see all the photo over here. You can go to follow me in the To the Moon Tiger Forum. Later I'll show you the QR code so that you can follow me and you can read this article over here, okay, so that to give you more confident how's the mall looks like and what are the brand there. And if you want to get more information on S-REIT, okay, I also tag a link over here. S-REIT, the trading symbol is CRPU.SI. Once you click on it, okay, you will be directed to the Tiger Forum S-REIT website. There are a lot more information over here for you to do your own research. Okay, and if you are using the Tiger apps, okay, if you like this REIT, after you have do all the due diligence, you like to trade, you just click on your Tiger app. Once you click on the ticker symbol itself, you are able to trade immediately because there's a trade button over there. Okay, so these are all the information available at the present moment. And under the REIT Savvy, if you want to have a one snapshot on what is S-REITs is all about, you can go to the REIT Savvy website overview. From here, you can see the market cap for all the Singapore REIT here. And when you mouse over here, you should be able to find the S-REIT over here. S-REIT is under the retail sector. Okay, I deselect the rest, and you can do some comparison of the retail sector for Singapore REIT. Okay, so the largest retail mall is Fraser Centrepoint Trust, and S-REIT is over here. You can see that S-REIT is has one of the highest DPU compared to the rest of the retail sector here. Okay, and in terms of gearing, S-REIT also has one of the lowest gearing. Okay, so the gearing ratio limit is over here, 50%. S-REIT is around here. Okay, one of the lowest, around 26%. Okay, and if you scroll all the way down, you can see and here. Okay, I need to change to another website. All right, give me a minute. Okay, REIT Savvy, S-REIT overview. You scroll all the way down, there is an overview on S-REIT. Then so that you have one summary page to understand more on the financial ratio of S-REIT. Okay, S-REIT based on the latest financial number at the present moment, the price to book is 0.87, which is underpriced. The yield around 8.8%. And these are all the analyst consensus. Okay, at the present moment, I think it's around how much? Around, I cannot remember the price already. Okay, the analyst consensus is 88 cents issued by DBS Research, 90 cents by KGI, and also UOB Kay Hian 98 cents, and 78 cents by Phillips Security. And these are all the financial ratio, gearing ratio, debt maturity ratio, cost of debt, and where are the location of the REIT, and also the DPU trend. Okay, you can find all the information over here. If you want to compare with the rest of the REITs, you can come to this screener, right? But this screener is more on a subscription base. Okay, by clicking the sort column, you can sort by TTMU. You can see from here, Stonewick has the highest DPU yield, followed by S-REIT. And if you click on S-REIT itself, you are able to see all the others financial ratio. For example, lease management, there are total 4 property here. Occupancy rate 98.5%. The will, just now Xin Yuan mentioned, the lease expiry is pretty short. This is designed by purpose so that they can replace an unperforming tenant to make sure they are continue to perform and also maintain high occupancy. Okay, and these are the fundamental ratio. And the debt management, the debt maturity profile is 4.2 years. All in interest cost 4.8%, interest coverage ratio 4.7 times, which is very healthy. And also we also have the ESG rating here. Government risk score 49, business risk score 18.5, and the MSCI ESG rating not available. All right, and also here you can show that the historical price to book at the present moment, S-REIT is trading at a fair value. Right, you just need to at least at the present moment, if you invest in S-REIT, you are not overpay the price. Okay, and you can see the past DPU chart over here. All right, so these are the information you can find in the REIT Savvy itself. Okay, now I go back to the presentation. Okay, some of the key resources you have to you can find it in this webinar. Okay, so if you want to look for additional information, okay, these are the QR code for you to access to the REIT Savvy website. If you are able to take a screenshot, you take a screenshot. If not, you can go back to view the recorded webinar and live stream. Okay, if you want to follow me, this is the QR code you can scan to follow me in the Tiger Forum. Okay, this is a QR code. You can see all my previous published article over here. Okay, and if you want to follow the rest of my seminar or webinar at SGX or some other places, okay, you can also follow me in my Telegram channel. All right, these are the QR code. And if you have any questions, you want to consult me or you need a private portfolio review, this is my contact number. So for today live stream session, I will give a complimentary portfolio review and also recommendation for the first 10 participants only who send me a WhatsApp message. All right, when you send me the WhatsApp message, just type review and also indicate your name. Okay, so in the review session, you have to bring your CDB statement and all your investment portfolio and just basically ask all the investment question you have. Okay, this is complimentary. Once you send me the message, I will get my personal assistant to contact you to make arrangement, all right, at my office. All right. So I think that's all for today's session. Thank you, Xing Yuan, for to attend this insight interview, and also thank you everyone for spending time to attend this live stream seminar or webinar. All right, thank you everyone, and I see you in the next Tiger Forum live streaming. Okay, bye bye.